there's 2.2 billion with a B, billions of dollars coming in new money into PREF equity. That's not how much money is in the multifamily world in PREF equity today. That's how much new money is coming into multifamily and PREF equity. What's going on, everybody? It's Matt Faircloth. Welcome to the Cash Flow Digest. And gratitude. If you guys are watching the show on Spotify and watching the video on Spotify, thank you. Even better, listening and watching this program live. We broadcast live at noon Eastern Standard every Friday at DeRosa Insiders. Thank you. Quadruple 10x. Thank you squared for being a part of our insiders community. Jump over to Facebook and join DeRosa Insiders. That is our awesome community where people are talking deals. Somebody's got a deal in Texas they're talking about right now on Facebook. I want to talk to you guys about something interesting, okay? There is a concept, an article we found that I subscribed to Multi-Housing News about this concept called PREF equity, right? And people are like, well, PREF equity, that's just paying a PREF, like a preferred return, to our equity. Not so, right? There is a concept called PREF equity. And I just read now in this article, there's 2.2 billion with a B. I put my pinky next to my mouth, billions of dollars coming in new money into PREF equity. That's not how much money is in the multifamily world in PREF equity today. That's how much new money is coming into multifamily and PREF equity. So let's break that down. What PREF equity is, whether you need it or not, and why it's coming in. So first, what PREF equity is. So PREF equity is a special kind of investment equity in a deal. And as you guys know, in raising private capital, I talk about two different things that investments can be in your deal. They can be debt, as in like, hey, John, can I borrow $1? And John says, sure, here's your $1. You owe me your $1 back plus 10% interest. That's debt. That's me borrowing money from someone at a fixed term. And then that debt gets collateral on my property, gets a lien on the property and everything like that. And I owe that debt typically a monthly payment back for exactly the interest rate on the money. Then there's equity, which sometimes people think, well, equity means upside. Equity means share in profit. Equity means partnership. It does, but it does not have to mean share in upside in the benefit and the uptick on a property, right? PREF equity is, ownership. It's a slice of the pie of a deal. So if your deal has depreciation losses, it can go towards your PREF equity investors, but it typically does not have any upside. Meaning like if a PREF equity investor has 10% ownership of your deal, if they provided 10% of the capital, or if your operating agreement gives them 10%, they're not going to get 10% of the profit. If your deal makes $100,000, they're not going to get 10 grand. They're going to get a preferred slice of profit. What PREF equity gets is they get first dibs, if that makes sense, right? If your deal has rent come in, then it pays its expenses, then it pays its mortgage. Got to do that first. Then whatever dollars come in behind that mortgage payment goes to the PREF equity. People think, oh no, all the investors get to share that, or it goes towards the investors' preferred returns. It does, unless you got PREF equity. PREF equity sits above, it sits in front of, in line of your LP investors. And it is something that's coming more and more into the market because it's needed, right? PREF equity is typically provided by institutions. Eric, yes, Class A shares. It is a good way to look at it. But DeRosa's Class A shares are not necessarily PREF equity, because I'm going to get to a structural issue on how PREF equity shares typically get structured with private equity firms. Okay. By the way, guys, for these guys watching on YouTube, Eric is live on our DeRosa Insiders channel on Facebook. And the privilege he gets is because he's a DeRosa Insiders member. He can just pop in here and ask me questions. What's up, Eric? High five. What PREF equity is something provided by financial institutions, and it typically comes in as another bite at the apple when an operator buys a deal and they need to put PREF equity in position, either to help them get across the closing line, because they can't raise the equity from their own LP investors from what's called common equity shares. These are those common equity. If the deal makes $1 and your common equity gets 70%, those are the folks that make the downline profit, the upside. If the deal sells and makes lots and lots of money, that's your common equity shares that make those profit returns. But PREF equity sits in front of them. There is a fixed rate of return that they get. It's typically in the mid to high teens, right? But what makes PREF equity interesting and intriguing to operators, and like a little fish hook that's dangling there in the water, is that only part of PREF equity is due at a given time. There's two words you guys need to get really clear with regards to PREF equity. And those words are current and accrual. So let's say that an institutional Goldman Sachs shows up on Eric Platter's door and says, hey, Eric, I'd like to offer you PREF equity. And here's a $3 million check for the apartment building you're buying, right? And I'm going to give you the money at 15%. And Eric would respond and say, okay, great. How much of that's current and how much of that accrues? What that means is, how much do I have to pay you on a monthly basis for me to be in compliance with you, right? So let's just say they say, okay, half of it. That means 7.5% Eric has to pay on a monthly basis. That is a little fish hook. That sounds intriguing. 7.5% is not that much money. And that means that when Eric refinances or he sells or when he does whatever he does for a capital event, that other 7.5% just carries along. And if Eric owns the deal for multiple years, that adds up like a little tiny little snowball like this. And then it becomes a really big snowball over time that he owes those PREF equity investors back. What's interesting about PREF equity, it makes it different from common equity, is that common equity doesn't snowball like that. There's a lot of upside that investors get. There's maybe a preferred return that they get in there, but it doesn't snowball really, really, really big with this guaranteed amount of money that the deal owes the PREF equity investor before anybody else gets paid, including the general partner. All right. Now, there's a lot more I could say about it, but the reason why a lot of PREF equity is coming in is for two reasons. Number one, common equity from people like cardiologists, doctors, and folks that I just pick on cardiologists just because it's a fun thing to say, LP investors in general, people that invest with us, anybody that invests with us, those typically go into common shares because they want upside in the deal, right? Those investors are either, just out of money, they're maybe a little scared, they're waiting for something to happen, but for all those reasons, they are waiting. And so there's not as much money to invest in deals anymore from just regular old folks like I talk about in my book, Raising Private Capital. So if somebody's got a deal, they need to go somewhere else to get that money. And they're starting to go to PREF equity. As an example of this article is they're going to 2.2 billion in money to close new deals. But the more commonplace that money's going is owners in distress. I am seeing more and more distress in disguise in this market that we're looking at today. And I cannot wait to talk to our guest about this today, is the amount of distress that's behind the scenes, and that distress is getting bridged. It's getting band-aided. We're putting little paint marks on the dam and everything like that to stop the dam from bursting in the multifamily market. And this PREF equity is getting used on deals for everything from buying bridge debt to keeping the trains running on time to whatever distress item that owner's having. They are going, instead of selling, they're going to PREF equity to bridge them through till tomorrow, hoping that interest rates go down, hoping that they are able to finish their business plan, whatever it may be, right? Because if you've got somebody in distress and they could borrow money at 15%, but only have to pay half of that now, only have to pay 7.5% now, they might be able to figure that out. Right now, it is kind of like a wolf in sheep's clothing in some ways, because the PREF equity providers, these folks are not in it to be nice. They're not in it for a hobby. They're in it to make money. And so the teeth that they have is they can take over the deal if they wanted to. If you end up falling out of compliance, they could knock out the GP altogether if they want to. Some of these folks are prepared to do that. And more importantly than all else, it can be very dangerous for LP investors, PREF equity, because as I said, PREF equity sits in front of all the LPs and that. So that's something folks need to be cautious of. To me, this is a sign of the continued cracks that are starting to show in the foundation in the multifamily world. I believe in multifamily long-term. My guest and I talked about this yesterday. America still needs housing, but there's maybe a bit of a correction that's going to happen that is going to require maybe more of this PREF equity to help bridge stuff. And that, but you're going to see more of these rescue funds or rescue dollars come in to try and help folks legitimately get around second base, proverbially, to get home. But you might see more and more of this PREF equity stuff come in to take advantage of a changing market as well. So that is my thoughts on PREF equity, guys. Happy to talk more about PREF equity, what it is. I could even get a PREF equity provider on this show if you guys want. Leave some comments down below, or get over to DeRosa Insiders and tag me in a comment if you guys want me to go into a deeper dive than I just did on PREF equity, right? That's what we got for today, guys, for the Cash Flow Digest. Thank you guys for watching, and have a great and profitable week. Hey guys, Matt Faircloth here. Thank you for listening again to the Cash Flow Digest. I really appreciate you guys doing that. If you guys want to hear more about what DeRosa Group has to offer, go to DeRosa Group, DeRosa Group.com, DeRosaGroup.com online. You can hear about all the great things that we offer from an educational standpoint and passive investment standpoint on our website. See you there. And if you guys want to join our online community, DeRosa Insiders on Facebook, where you can watch this program get recorded every Friday at noon Eastern, and you can come on as even a guest or ask questions on the show. We hope to see you guys on our online community, DeRosa Insiders. See you there.